The NASDAQ 100, often listed on platforms as US100, tracks the largest non-financial companies in the market. Because of its heavy tech weighting, it moves fast. That high volatility provides massive daily earning potential, provided you know exactly when to strike. Welcome to the FX GOAT Masterclass. By the end of this session, you are going to master two specific structures, the V and W patterns, allowing you to execute pinpoint trades in this high-speed environment. Before we even look at a chart, you need to clear 4 strict prerequisites. You must have a broker that offers US100 trading. You need a minimum equity of $500. Your account requires a leverage of 1 to 500 or greater. And finally, you must be operating on a 15-minute time frame. You can have the perfect account setup, but without a structured methodology, that capital is exposed. We are going to follow the next steps exactly to protect your balance and find reliable entries. Step 1 is understanding what actually drives the US100. It is a composite index, meaning its overall movement is directly correlated to the top 100 non-financial US stocks. This visualization illustrates our core directional rule. When those underlying US stocks are trending upwards, the US100 will be bullish. When the overall stock market drops and turns bearish, the US100 will mirror that drop. But that movement doesn't happen evenly throughout the day. To capture the necessary volatility for our patterns, we only operate within a very strict daily window, 15:30 to 2100 South African time. If you try to force trades outside this specific window, you will likely get trapped in flat, unprofitable markets, where the index is simply drifting. Now that we have our time window, the absolute first technical step of every trading day is marking the battlefield. We need to identify our previous highs and lows. Looking at this chart, you see how we map the upper ceiling. We draw a resistance zone across the previous high, creating a boundary where price struggled. Scanning down, we do the exact same thing for the floor to mark our support zone. The golden rule of price action is we never guess which direction the market is going. Instead, we sit on our hands and let the price travel directly to these marked zones. Trading before the price reaches these boundaries means you are trading blind. That impatience is the primary cause of premature entries and unnecessary losses. Once the price reaches our marked zones, we wait for our first setup, the V pattern. To trade this, we first let the market pick its initial direction. This chart shows the first half of the structure. A red diagonal line traces an aggressive price drop to our previous low, followed by a bounce. Then we watch the price drop back to retest that level. That second touch is our entry point. But simply touching the line is not enough. You must wait for a clear rejection candle to form at this retest. If the candle doesn't show rejection, we do not enter the trade. These stacked charts prove the pattern works in both directions. On the bottom, we see a buy setup triggered at the low retest. On the top, the exact inverse occurs, creating a sell setup when the price retests the previous high. Risk management for this setup is non-negotiable. Your stop loss must be placed exactly 50 points away from your entry. Your take-profit target is always the opposing previous high or low. By forcing yourself to wait for structural confirmation at the retest, the V pattern removes the emotion of chasing an unpredictable breakout. Our secondary setup operates on the same logic. This is the W pattern for buying, and its inverse, the M pattern for selling. In this top chart, an initial V shape begins to form, but instead of launching into a trend, price returns to the support zone again, drawing a wider W structure. Your precise entry point sets on that final leg's rejection candle. That's your signal to buy. Looking at the bottom chart, we apply the exact same mechanics to a bearish market. The price creates a red M shape, testing the previous high resistance, providing our trigger to sell. The W pattern involves a more complex sequence of retests, but the core philosophy remains identical to the V pattern. You exercise patience, wait for the price to hit the marked zone, and strike only when you see the rejection candle. Compare these two approaches. On the left, a raw chart full of confusing price action. On the right, a fully mapped FX GOAT setup showing clear boundaries, precise stop losses, and mathematical structures. Your daily operational sequence is simple. Wait for 15:30 South African time, mark your previous highs and lows, wait for the V or W pattern to retest those exact zones, and execute. Before you risk any real capital, take this sequence to a demo account. Practice mapping your zones and spotting those critical rejection candles. When you master these two specific patterns, you stop gambling. You turn market volatility into a series of structured, repeatable opportunities. Subscribe for more breakdowns. Remember to practice your execution safely and review the FX GOAT PDF guide for a deeper dive